Join us right now with more on the Fed and the fixed income market. Kelsey Berro is a JPMorgan Asset Management fixed income portfolio manager. Good morning to you.
Morning.
Before we get into the bond vigilantes, the Trump administration, everything else, I am curious about the conversation we've been having the last hour. I don't know if you saw, as it relates to both Elon Musk's comment, but really Congressman Lee's comment about the Fed being an unconstitutional structure, if you will, that should be part of the executive branch, and what you think that would mean if someone were to actually challenge it.
Well, I mean, I'm not a legal expert,
right,
but I would imagine it would be very poorly received by financial markets, both the bond market and the stock market. And so ideally, the Federal Reserve is really a bedrock of the financial system. And so I think right now that's not on anyone in the financial markets bingo card and would certainly be a very shocking development.
When you see tweets like this, the reason I even mention it, because you're right, it doesn't seem normal. It doesn't seem, but there have been things that don't seem normal that have then over time become, quote unquote, normalized. And Elon Musk has an enormous amount of influence in this new administration. And whether you think that there will be demonstrable efforts to change the way this works.
Well, maybe.
Obviously, Jay Powell is saying.
My suggestion would be maybe he should watch Hamilton the musical. Maybe that will inspire him a little bit to recognize that it is certainly an important part of the fixed income market and a bedrock of the global financial system.
The executive branch screws up enough already. They don't need another thing to be able to screw up, even though the Fed does pretty well screwing up itself. I mean, if you go back to the financial crisis, you go back to staying at zero this last time, the Fed doesn't need any help making mistakes. I mean, you could make it. I mean, they've screwed up a lot of things, but you want them to be the ones screwing it up.
They've also done some pretty good things, too, over time.
I guess.
Right? I mean,
maybe. I think the economy itself does the best things, usually, if you just get out of the way. I think they're way too much a part of our life. But we'd never raise rates again. If the executive branch, every president wants zero interest rates, and we'd be stuck at zero. I don't see how the dollar would stay the reserve currency of the world if the president got his way all the time. I mean, Nixon would have lowered rates. H.W. Bush might have beaten Bill Clinton if Greenspan, hadn't raised rates. So they always do it.
Well, it is interesting, right, to compare 2016 to 2024, because if you think about the bond market reaction, what I've noticed is the fact that the 10-year yield is actually 8 basis points lower than it was the Friday before the election. So I think there was a lot of anticipation, a lot of positioning ahead of the fact. And, while we have seen yields go higher, I mean, this is a significantly different environment. So think about where the 10-year was in 2016. It was at 1.5%, and the Fed was at zero, and they were actually starting a hiking cycle. Now we're in a significantly different place. Right. Yields are already at 4%. The Fed has actually done a full hiking cycle. They're actually now cutting rates. So I think, when I'm assessing the move that we've seen so far in 10-year Treasury yields, could they go higher? Yes, but I think there actually are differences and potentially some limits or guardrails relative to 2016.
Okay, so what do those guardrails look like, and how high could it go?
I think that you have to recognize that we need to expect that the range of outcomes has expanded quite a lot. And the market is really grappling with what could happen, the sequencing of what could happen. And then in the meantime, how is the economy going to perform? Because when we look at these initiatives, they're not going to impact the data points we get this week or even next month. And so the Fed, on the other hand, is really going to have to stick to the data that they see in front of them, which is still, moderate inflation, a cooling labor market, an economy that is still very, very strong. And so what that says to us when we're building our fixed income portfolios is, this is still a good time to be, building portfolios that have a heavy lean towards credit. So that's something you can get 6 to 8% yield on. Because, generally the fundamentals are still quite positive.
You just mentioned a cooling labor market. And one of the interesting dynamics that's now at play is what's going to happen with immigration. And one of the things you're already starting to hear about, even in the past week, is folks that were planning to illegally or in some cases legally try to immigrate here may not make those treks and those trips There's obviously the separate piece, which is that the border czar was announced over the weekend and is going to largely be responsible for deporting lots of people. That's going to create its own sort of execution challenges and questions about, how humanely that can all be done. But it is going to do something, I imagine, to the labor market and the cost of that labor. How do you square those circles?
Yeah, I mean, it's a really good point. So if you just think about what was one of the factors that drove inflation over the last many years, it was an imbalance. There was too many job openings, and there were too few people to fill those. So essentially, the metric is you looked at the number of job openings relative to unemployed. That got to 2 to 1. So that was extremely imbalanced. And so you saw large increases in wages to try to capture whatever spare labor there was. Now, that ratio is back to 1 to 1. Mm-hmm. So we've made a ton of progress here. And so I think for now, we don't know exactly how this is going to impact it. But if it's going to push that ratio back up again, you would imagine that eventually...
Do you model it doing that? Because I think to myself, do you remember it during the pandemic, there were restaurants that couldn't open because they didn't have enough folks in the quote unquote back of the house, back of the kitchen, doing the work, doing the dishes, all sorts of work that, to be honest with you, is sometimes being done by folks who may not be here legally.
Yep. Well, it depends on how all of the other pieces move. So one of the things that has also happened is that you've had an increase in participation. Participation, particularly for women, has continued to rise. Participation for prime-age men is actually still kind of low relative to prior experiences. So perhaps, there will be some filling of those roles by other people who are here who can take the role.